Hey guys, thank you for joining me on another video. Today, I want to talk about an introduction to bonding for contractors. 2024 was a great year for bonding. I issued over $12 million in surety bonding this year to help my clients access their projects, finish their work, get paid, and earn profits. Now, 2024, we started seeing a shift from private work, such as residential and commercial private work, to public work, municipal jobs. And therefore, a lot of our clients needed to get into bonding. Some of them didn't understand bonding when we first started. So that $12 million I'm talking about, all those contracts that we were able to bond to allow our clients to do the job, it was new to a lot of people. So they had to kind of learn on the fly. Well, I helped them do that. And in today's video, I'm going to help you understand bonding so that by the end of this video, you are going to be familiar and comfortable with how bonding works and where you should get started. Thanks again for joining me. Please remember, if you like my videos, if you find them helpful and you want to help support our channel, give me a thumbs up, subscribe, and hit the little notification bell so that you're made aware of any future videos that I may release. The first thing is, what is a bond? Specifically, what is a surety bond? A surety bond is a promise to the project owner that you, the contractor, are going to fulfill the obligations and complete the job per the standards of the contract. So let's talk about three common types of surety bonds that you may have heard of. The first one is the bid bond. I talk about the bid bond first because this normally comes at the time of a bid. When you submit your bid, the project owner wants to ensure that you're submitting a bid bond so that one, you're going to honor your bid if you're awarded the job, but two, they want to make sure that you're bondable at the time of the bid. You know, when you go through the process of getting a bid bond, you have to go through the same underwriting as you would for a final bond. So this will show the obligee or the project owner that you can qualify, you can indeed get a bond. Number two is a payment bond. This is going to ensure the obligee, and by the way, a payment bond and performance bond, which are the next two that I'm going to talk about, typically come hand in hand at the time that you're awarded the job. You have to now turn these bonds in so that the surety company, again, is promising the obligee or the project owner that you are going to finish the job according to your contract. You're going to meet your obligations. And the payment bond is meeting your obligations to pay your labor and your materials for that project. And the performance bond is that you're going to meet your obligations per the specs of the job, typically for the time period that it's going to take you to complete the work. Now, you may ask yourself, what are some other reasons why I may need bonding or why do contractors need bonding? Number one is credibility. Again, going back to what I said about on bid bonds. It shows that the contractor or the firm, in this case you, are financially secure enough that you can qualify for a bond. The obligees or the project owners, they feel more comfortable when you can turn in a bond, not only because it's a promise, as I said, or a guarantee, but also they know that you're credible enough to have qualified for that bonding. The second is access to bigger jobs. As you start getting into larger projects, you're not going to be able to get on those jobs. You're not going to be able to perform the work if you can't supply bonding. So those are two big reasons why. Like I said, 2024, we issued over $12 million in contract bonds. Now, of course, that's not one bond. That was probably split up into, maybe 60 to 70 different bonds. So some smaller, some larger contracts. But you can imagine what this did for our clients, for them to be able to supply the bonds for credibility and to gain access to bigger jobs. The next step, and by the way, this goes along with an article I wrote today, posted it on my website and on my LinkedIn profile. If we're not connected on LinkedIn, feel free to reach out, check out my articles that I wrote there. But the next step is, what's the underwriting process to qualify for a bond? Well, this kind of breaks down into two different paths. One is express bonding. So here's a pro tip, and you'll see this on my article. If you're a smaller contractor, if you're just now getting into bonding for the first time, if it's not something that you don't think you're going to need bonding on a regular basis, maybe you're doing a few jobs a year, they're not going to exceed $1 million per job, you're not going to need $1 million in total bonding capacity, there's express bonding out there. Express bonding is simple, it's easy, the underwriting fees aren't as high, and a simple credit check. With the credit check and some simple history about your company, you can qualify for express bonding. A lot less stressful, a lot less time that it takes, not as much underwriting, you don't have to supply as much information, but think about express bonding if this is newer to you. Now, when you start to get into more complicated projects or larger bonding needs, bigger jobs, you're doing more jobs so that your aggregate needs to be above express bonding limits, well, then you're going to get into what we call full bonding submissions. And here, this is where the bonding companies are going to do an entire check. They're going to do a full underwriting. They want to see your credit worthiness, your financial backing, cash verifications, P&L, profit and loss statements, balance sheets. They want to see financial statements. They want to see work in progress reports to see what types of jobs you have going, if you have the means to support more work. They're going to want to see personal financial statements. They want to know about what kind of liquidity or what kind of equity do you have to repay. Because remember, bond is not insurance. Surety bonding is not an insurance policy. And here's the major difference. I don't want to get too deep into it, but essentially, when you buy an insurance policy, and it could be a retention or it could be deductible, but when you pay your insurance insurance premium and you have a loss or a claim is made against that policy, and that insurance company pays out the claim or pays out the loss, they don't come back to you and say, Mr. Contractor, we just paid $100,000 for this property damage claim that you had. You owe us $100,000 back in return. You owe the deductible, you owe the retention, but you don't owe back the amount of the loss. You pay your premium, and in return for that, they indemnify you for that loss. Well, on a surety claim, it's different. You have to pay back the surety company. So really, all the surety company is doing is putting up that collateral on your behalf to say that you're worthy, that here's the bond, here's the promise, here's the guarantee. But if the claim is made against the surety company and they wind up paying out that claim or that loss, it comes back on you to repay them. Next, and one of the more confusing parts of the bonding process is when we get to the point where the bonding company hands over a general indemnity or agreement, otherwise known as a GIA. What is that? Why are you signing it? People get scared. Sometimes the GIA is going to go to multiple people. If you're an entity that has multiple owners, if you're a sole proprietor and you're married, especially in a state like California where it's a right of ownership state, your spouse is going to have to sign the GIA also. If you're a partnership, your partner is going to sign the GIA. If there's any ownership of the entity within a trust, the members of the trust are going to have to sign that general indemnity agreement. And people get to that point and they say, well, what is this? What am I signing? Well, that general indemnity agreement is your promise to repay, as I just stated, repay that surety company in the event for any loss, any money spent by that surety company in the event of a claim. Again, you're indemnifying them. You're promising to pay them back. And that's what a general indemnity agreement is. And what people really question a lot, and it's important to understand, is that there is personal indemnification to that surety company. So even if you're an entity, let's say you're a corporation, you're going to indemnify them as an owner of the corporation from the corporation, but you're also going to indemnify them as an owner of the company personally. Okay. And that's where it could get kind of risky because you're guaranteeing that you're going to pay them back personally and also as a corporation. Now, in some cases, an entity may be owned by other entities. This is especially the case when it comes to LLCs. There could be different layers of ownership within an LLC where other LLCs or other entities own a part of the entity that's being bonded. If that's the case, the indemnity agreement is still going to flow down to the owners of those entities. There's very rare situations. And when we start getting into much larger bonding or working with big companies where there might be some private equity involved or maybe even a publicly traded entity, sometimes you can get creative with collateralization or set aside letters from banks, things of that nature. But for smaller companies and especially contractors that are individually owned or owned by multiple parties or people, you're not going to be able to get away with not indemnifying the bond company from a personal level. That's really important to understand. So now that I scared you about the indemnity agreement, and by the way, I didn't mean to do that. I just want to make sure that you understand before you start getting into this. We see cases where contractors come to us after they've gotten so far along in the bid. They've done all this work to put the bid together. They're really excited to get the job. And then the obligee or the project owner says, well, where's my bond? So I don't want you to get to that point. I want you to be ready to go, prepared, understanding. But here's some benefits of bonding. It's an investment and it could be really helpful. And I've talked to a lot of my clients. I probably bond for about 50 different entities or companies at this point. And a lot of those clients, I've seen them have great success because they took the time and put the investment into getting those bonds, to qualifying for the bonds. So what are the benefits of bonding? Well, number one, trustworthiness. When you're bidding these jobs, when you're out there trying to earn more work or creating relationships with municipalities or big generals or people that are asking for the bonds, you show more trustworthiness when your client knows that you can qualify for a bond or knows that you understand that the whole financial instrument that's bonding. So that's the benefit number one. Benefit number two is it opens the doors for more opportunities so you can do more work, so that you have other different channels or avenues of revenue sources. I think it's always great to diversify. In our business, we really especially do so. But as a contractor, you don't want to put all your eggs in one basket. If you're doing private work in the residential arena, what if that starts to dry up? If you're doing commercial work, TI work, what if commercial work starts to dry up? You want to have different areas where you can generate revenue and do business. Well, bonding is going to open the doors for more opportunities. And then finally, as you complete jobs and you clear bonding and you show that surety company, which by the way, you're developing a relationship with them also, that you're capable of doing these jobs without having any issues, it clears more way for you to grow higher levels of bonding and more bonding capacity. So that can be helpful as your business grows and you start to look at larger jobs. And finally, how can our agency or how can I personally help you? Well, I'll take you through the process. I've been doing bonding for over 20 years. I actually handle all the contract bonding for my whole office, regardless of the agent assigned to a client. If they're a contractor and they need help with their bonding or getting surety bonding, whether it's pre-approvals or letters of capacity or qualifying for certain programs and understanding what jobs they can and can't bid, I help with that. So I can help you with the pre-approval. I can help you with underwriting. I can tell you what programs are out there, what products are available for you. So give us a call. We have lots of years of experience. I personally would love to talk talk to you about your bonding needs. You can call me at 858-384-1507. You can email me at mike@foagency.com or visit the blog I spoke about. There's a form at the bottom that you can fill out. I will get back to you right away. Same with my LinkedIn article. At the very bottom, there's a link that you can fill out a form. Allows us to start the conversation, figure out where you fit in. I could explain a little more to you, help you through the process. I have no problem. I enjoy doing that. Also, remember, you can comment on any of my YouTube videos. I reply to everyone. And reach out. Let me know how I can help. I hope this video was helpful. Let me know what you think. And if I don't see you before the end of 2024, wishing you and your family a very happy, very healthy holiday season and an excellent and prosperous 2025. Thanks for watching. You take care.